Thank you everyone for tuning in. Today we're joined by Hugo Rogers, the Chief Investment Officer of Deltec Bank. Hugo, thanks for joining us. So first question I'd like to ask, 2020 was a year with massive challenges for markets, economies, and policymakers. How was 2020 for Deltec from an investment point of view?
Yeah, I mean, obviously it was a very challenging year for many people, challenging from a health perspective with COVID, but equally challenging from an economic point of view, because the way to tackle COVID it was decided that the right approach was to lock down economies. So policymakers really had to step in to bridge the gap that they created by locking down economies. From an investment point of view, their responses really did bridge a gap. There was a very sudden decline in economic activity. Employment fell very rapidly. We saw a massive and sudden recession. But policymakers, understanding the risks, stepped in with massive monetary and fiscal support. So there's been more than $10 trillion of assets purchased by central banks in the last 8-9 months. And policymakers have been running double-digit, high teens in some cases, budget deficits to tackle the problem. What that's actually meant is that several assets have actually very rapidly caught back up with themselves, and in many cases actually pushed to all new highs. And so from an investment point of view, the most important thing to be was nimble and understand the new paradigm that this pandemic has really introduced. And we were very nimble in 2020, and we delivered excellent results in balanced portfolios, our high teens, our absolute return funds up between 35 and 40% on the year, and other funds are way ahead of benchmarks, MSCI World for our long-only fund. And we've also had great success with some of the products we've launched as well. So we've delivered excellent results for clients in what has been a very challenging year for economies, societies, policymakers, and market participants.
This is great results. Can we ask, how are they achieved?
Well, really, we entered in a very, very good position. So we entered 2020 with some very clear bets that we were past the peak in the interest rate cycle, that interest rates were coming down. We had that position actually all through 2019 as well. So we had a very large allocation to duration, to long-dated bonds, a very large allocation to alternatives like gold. And within equities, we had a very narrow focus on large cap US tech behemoths. So all of that served us very, very well entering the crisis. At no point will be down very much at all, even though equity markets fell more than 30%. And from that point, we have really tuned into the cadence of the stimulus, the fiscal and monetary stimulus that came, and then the recovery that we saw coming through quite quickly and then petering out, but with hopes certainly in this last quarter of a vaccine. So each one of those changes, long bonds, long alternatives, tech behemoths, and then into a recovery of global trade, and finally into a recovery in more cyclical assets. We've timed each of those moves very well as well. So we went into it correctly, and we got the cadence of the recovery right as well.
Okay. With that in mind, what is changing now as we move into 2021? What are investors' key concerns as we start the year?
Well, I mean, that's so prescient. We have significant changes going on. The most significant of which is actually the potential rollout of the vaccine and the immunity that might confer, certainly initially to the vulnerable, which should allow economies to open back up again as we get through the spring. Certainly towards summer, there should be a significant proportion of developed market populations which have received a vaccination and should receive immunity. So that's the biggest single change. There are a number of things that have stayed the same. So central banks are still absolutely there, printing money, buying assets. We saw that in December, a reiteration of asset purchases and an expansion of asset purchases in the case of the ECB. So maximum monetization, which is the thesis that we have been expounding for the last 2 years to our clients, that does actually continue, but we have on top of that some icing on this cake, which is the hope of a vaccine-led recovery, which should benefit cyclical assets as we head into 2021. Within that framework, though, there is a warning, and that warning is that this level of monetization, this level of asset purchases, this level of stimulus, if it is actually met with a vaccine-led recovery, those two forces working together could unleash a wave of inflation. It may or may not be temporary because there are still big deflationary forces out there, but even a temporary rise in inflation could undermine some of the cornerstones of the asset market setup that we see, and that is the rates will stay near zero for a very long period of time. If that is challenged, then you're going to get to see potentially more significant rotations out of some assets, not just assets rising in unity.
With that setup in mind, could you list your high-level calls and top picks for the year?
Yes, so running on from that, the significant position that we had in duration has now, and that's long-dated government bonds, has now been reduced. We are now underweight duration. So if interest rates and interest rate expectations do rise, we should benefit on a relative basis. We still hold lots of bonds, but the lower quality, not just developed market government debt and very high quality corporate debts. We have a lower rated and shorter duration bonds. So that's one call, an underweight in duration. We've maintained a very significant position in the beneficiaries of maximum monetization. So that does include gold, it includes other commodities as well. It also includes a large position in Bitcoin, which has obviously received a lot of attention recently. We bought Bitcoin for our clients at about $9,300. So that worked very well through 2020, and we expect it to continue working well in 2021 as the printing presses continue to run hot. Within equities, we have a more balanced portfolio. We had a very narrow portfolio in 2020, concentrating on large cap US tech stocks, not quite the rocket ships that hit the headlines, because we find it difficult to justify valuations of companies that actually burn cash. But the large tech behemoths are still in our portfolio. We still like them for 2021, but they are slightly smaller in size, and the portfolio is balanced with quite a significant exposure in companies we think will benefit from a revival in activity as we enter into the year. So a revival in cyclical value type stocks. So we have a balanced equity portfolio. We do have companies in the oil sector, in leisure and travel within that component of our equity exposure.